And Thursday the 22nd brought about a pretty muted day considering it got some pretty big data. At the start of the day, UMBS were down 2 basis points on the open. Treasury were about the same. Then we got jobless claims, which came in at 216,000 versus a 222,000 forecast. It was 214,000 last time. We got third quarter GDP, which was the final revision, which came in at 3.2% when it was expected to be 2.9%. That's not going to help inflation. GDP consumer spending was up. It came in at 2.3% on an estimate of 1.7%. We keep buying stuff. Third quarter GDP was revised upward from 2.9 to 3.2% according to the BEA. The revision was driven primarily by the upward adjustment to consumer spending, primarily in services. The PCE price index component was revised upward by 0.1% to 4.8%. The PCE price index, excluding food and energy, was revised upward 0.1% as well. So now the Atlanta Fed's GDP now model sees a 2.7% GDP growth in quarter four. So much for the whole air quote recession thing. It is important to understand that the affordability is more than just the mortgage payment. It is also a function of income. Since incomes have been rising at the fastest rate in decades, that helps blunt the impact of the rising payments. October, November will almost certainly be the peak of unaffordability as rates continue to fall and home appreciation slows. As Keynes discussed in Sticky Wages, they primarily don't fall, so higher incomes are baked into the cake already. Falling rates and prices will square the circle. Tomorrow we get the PCE report, personal consumption expenditures. This comes out early for most of the country. Previous reports showed inflation at 6% with a core of 5%. Like we said, it's supposed to be about 2. Market is expecting 5.5 to 4.7. Pretty wide range there. Drop largely because of cooling housing. Shelter is 39% of the number. If that comes in hot, it'll be a bad move for the bonds. At the end of the day, we were down 8 basis points after opening down 2. So a pretty muted day considering some pretty important news there. We also got a great report from MBS Highway where they pointed out that next month we are going to get several new voting members of the Federal Reserve and some people are going out. So the predictions are that the Fed's going to get much more dovish. Despite a new post from Elliot Eisenberg over at econ70.com, which was a great analysis. Despite rising rates and recession fears, redesign of the whole mortgage market resulting from Dodd-Frank and other regulations, which have culminated in substantially tighter underwriting standards, it would take a 40 to 45% decline in house prices to cause damage similar to what we saw in 2006 to 2009. Moreover, back then the average price decline was 28%. This time is definitely different, which is a great analysis from Elliot, very smart guy. Check him out. We also got a post from our sponsor at WellThatMakesSense.com, another post from the great book Persuasion. Metaphor is a metador. This is talking about how metaphor and Joseph Campbell type stories really kind of walk around people's resistance, and it's a great way to sell things. We had a short day on the bond market on Friday the 23rd, otherwise known as Christmas Eve. UMBS was down 22 basis points on the open, worsened 6 basis points while I wrote my morning post. 10-year yields were a hair higher coming into data and are now a hair higher at the start of the day. We got the core PCE, personal consumption expenditures price index, which came in at 4.7% on a 4.7% forecast. It was 5% previously. Durable goods came in at negative 2.1 on a negative 0.6 forecast. It was 0.7 previously. Non-defense, excluding aircraft, came in at 0.2 and was supposed to be flat. Incomes rose 0.4% on a forecast of 0.3%. It was 0.7 previous, so incomes are coming down a little bit, which they kind of need to do so people stop buying stuff so we can get rid of inflation. Outlays came in at plus 0.1% on a 0.2 forecast. It was 0.9 previously, so hopefully people are stopping spending so much money. Tough for the economy, better for inflation, kind of need to do it. U.S. December final Michigan sentiment rose to 59.7 on an estimate of 59.1. Expectations index rose to 59.9 from 55.6 previous month. November new home sales rose 5.8% to a 640,000 annualized rate. New home sales rose to 640,000, like we said. Don't know why I wrote that twice. Estimate was 600,000, so way better than expectations. Median new home price rose 9.5% year over year to 471,200. The average. After passing the Senate, the House will vote today on a new $1.66 trillion government spending bill that gives more money for Ukraine support, restricts TikTok, reforms election certification, and will lead to more Treasury issuance. And that is something the bond market didn't really like, so that's why we were down 20 basis points on the day. We end the week in a very narrow consolidating range. We have a lot of technical indicators colliding with each other right around that 101 mark, and we close the day at 100.72. We also have big support here at the Fibonacci of 99.845, which is supported also by that 50-day moving average. So we have a lot of technicals going into a very narrow range, so hopefully we get some more stability next week. Speaking of next week, we have a Monday closure due to the Christmas holiday observance. We get Case-Shiller on Tuesday, as well as FHFA home price index. Then we have Treasury. We have 2-year and 5-year note auctions on Wednesday, which could move the market. A 7-year note on Thursday before being closed on Friday early for New Year's Eve. So a lot of stuff in a short week next week. And I hope everybody has a Merry Christmas and has a great New Year's. We will have some more posts next week. But in the meantime, check out our common sources and influences, particularly our sponsor at WellThatMakesSense.com.